Yeah, so good afternoon, Ian and Faith. Good afternoon.
Good afternoon.
Yeah, so let me take this opportunity to welcome you to today's class. Summer. All right. I think there should be more of us joining. So probably we give them some 3 minutes before we can start. All right. So I think I will continue. So once more, welcome to this session for today. Now, what was our discussion in the last class? I think in the last class we had covered, we must have covered financial statements forecasting, as well as the consolidated financial statements. Before that, what did we cover? Who can remember what we had covered before that? The other Sunday. Yes, anyone? The other Sunday, what was the discussion? Yeah, so you guys do not remember, yeah? Now, allow me to ask, there is a question which we started on the published financial statements. Did we complete on it? The question for the last sitting, did we complete on it? The one on the published financials. Let me just project this on the screen so that I remind you of what I'm talking about, yeah? Yeah, so this particular question, did we complete on it? Because I'm seeing that we did introduce it, but and of course we started on the workings for it. I'm seeing we stopped at this point of depreciation expense, yeah? Did we finally complete on this question?
I think we did when we were with the classes we did over Easter.
Yes.
I think there were 3 classes that we did over Easter.
Yes.
Yeah.
So did we complete on this one?
Yes, yes. And then we went we went into forecasting.
Or we went into focusing. So we completed on this question, you're very sure, right?
Yes, we did.
Then that is fine. So I think on the area for financial reporting, what we are there for left with is cash flows. Or had we done the cash flows? Yes. Have we done the cash flows statements?
No.
Not yet, yeah? So that will mean that therefore today we start on the statement of cash flows. And in that respect, what I'll do, yeah, is to send to your WhatsApp group something on cash flows. I'll send you an Excel which has the format for the statement of cash flows, yeah? Because all we need to know is how to do a statement of cash flows given information about a company, yeah? So let me send to your WhatsApp group an Excel with a statement of cash flows. Get to have a look at that first, and then we proceed on to to do a question on the same, yeah? All right, so check your WhatsApp group. I've sent an Excel with the format for the statement of cash flows. Yeah, and by the way, the accounting standard which governs the statements of cash flow is International Accounting Standard number 7, yeah? And the format which I'm showing you is what we call the indirect format, yeah? So get to remind yourself first of how the statement of cash flow looks like. And then once you have done that, we will proceed to look at illustration question, yeah? Our reference question will be one which has been set before, and this is December. When you check the first exam, that was December. So when you check December, so December 2020, December 2022, this was actually question number 24, yeah? We had a question set on this, and so one of the requirements in your syllabus is that you know how this statement is done, yeah? All right. So get to have a look at that first before we proceed to do a question on the same. All right, so if you've had a look at that, then I think we can proceed to that reference question. The question which we'll use to illustrate how this is done is one which has been set before. Yeah, when you look at December 2022, this was question number 24. We had something on the statement of what? Cash flows, yeah? So that very quickly access that question and read through it so that we get to prepare one, yeah? All right. So access that question and please read through it first, yeah? I think somebody could screenshot the question and send the screenshot to your WhatsApp group so that those who do not have can also get a copy, yeah? All right.
Okay, Chacha. Hmm?
Yeah, so get to read through the question first so that we proceed on, yeah? Mwalimu. Ibrahim, I don't know what you are doing. Why are you doing this to my Excel? Ibrahim? Ibrahim, Ibrahim, kindly go away with what you've done on the screen. Ibrahim, erase what you've done on the screen. Ibrahim, kindly erase what you've done on the screen so that our screen is clear. Ms. Ibrahim, I don't understand what you are doing, yeah? I don't know why I have all this writing on my screen, yeah? All right, so I think we can proceed on with the question. And the questions on our cash flow will always be set in the same manner. In terms of number one, you will be provided with an income statement, and the income statement will always be for the current year, yeah? And then secondly, you will be provided with balance sheets. You will be provided with balance sheets, and there will be two balance sheets, one for the current year, and then another one for the previous year, so that the balance sheet for the current year will provide you with what we can call the brought forward balances, opening balances, or rather the current year's balance sheet will give us the carried forward balances. Those are the closing balances. And then the previous year's balance sheet will give us the balances brought forward, yeah? So opening balances. And then thirdly, the question will also provide additional info, and that will be it. With respect to the additional info, we know that in accounting, we should do workings. So that as starting a point, then for a question like this is then the workings. Now, let's start with note number 1, yeah, and see what we are told in note number 1, and make necessary adjustments as far as the note 1 is then concerned. When you look at note number 1, we are told that property, plant, and equipment held by the company are items of plant and equipment, and then freehold premises. We are then told that during the year ended 30th June, this is 2022, items of plant and equipment with original cost of 40 million were disposed of, resulting in a loss, which was 6 million shillings. Now that was charged to the administrative expenses. Thereafter, you are told that the items had a net book value of 28 million, remember, as at the disposal date. So that note is talking about a disposal of some item of PPE, and obviously that affects the PPE account. What we will therefore do is to prepare as working number one, an account for the PPE. So I don't know whether you know how to draw accounts in Excel, yeah? It's as simple as you work with the borders. So you work with the borders, yeah? So that I'll have that, and then I'll use the left border, so that that's a T account. This is a PPE account. All right. Being an asset, you have to remember that it's a debit, and so on the debit side, we will start with the balance brought forward. The balance brought forward, and these ones you get in the balance sheet. Remember, the current year was the year 2022, and then for the balance sheet, together with that, you are provided with the balance sheet for the previous year. That's now the balance sheet for 2021. So like we said before, they brought forward the balances, get them in the previous year's what? Balance sheet. And when you look at the balance sheet for the year 2021, the value for PPE, you know, we had 260.4. You need to, on the credit, compare that with the balance carried forward. And the carried forward the balance is the balances are carried forward around the year 2022. Now, the carried forward balance for PPE under the balance sheet for 2022, we have 327. So we have 327. The adjustment which we want to make on PPE, remember, is for the disposal, which we are told in note number 1. When we've disposed part of them, remember that means that we decrease PPE. And what does it mean to decrease PPE? Do we debit or do we credit PPE account? Somebody. Do we debit or credit PPE account? So PPE is a debit, remember. If you want to decrease it, by that disposal, it means that you now credit it, so that on the credit of PPE account, we will acknowledge that we have disposal, and you then report the disposal at the book value of the asset that we disposed. When you look at note number 1, the last statement is very clear that the disposed item had what net book value. We are told that this was 28. So that was 28. A few things to note about the same note number 1, yeah. So that working 2, it is important we note that there was a loss. There was a loss on disposal. Remember, if the loss on our disposal is not given directly, the way the question has done it, then you'll have to compute it. But in this case, fortunately, we had that loss. And the question says that the loss was what figure? Now 6. You must remember that later, the 6 will be adjusted for under the operating cash flows. So the 6 will be adjusted for under the operating what? Cash flows. So that we will adjust for. So under the operating cash flows, now later. The third thing to note about this disposal, so is working number 3, you have to remember that whenever you dispose, you then have cash from disposal. So you then have cash actually received. You then have cash actually received from disposal. The cash actually received from a disposal. You know, disposal is the sale of the asset. Disposal means sale of the asset. And so how much cash did we receive when this asset was sold? Now remember, the net book value of the asset sold was this 28. The question says that on sale, we made a loss of 6 million. This means that we had sold the asset for how much cash? Somebody. If the book value was this 28 million, and we sold the asset for a loss of 6 million, that means we sold it for how much cash? Eh? That means we sold it for how much cash? Somebody? Who is going to talk to me? Who is going to talk to me? That means we sold it for how much cash? Yeah, so I can see Faith and Ian says in the chat that at 22 million. So that's right. That means we sold it for 22 million, meaning that you take 28, the book value of the asset disposed, now minus the loss on our disposal 6, you come up with a cash of how much? Now that's 22 million. The cash from proceeds of asset sale, or rather proceeds from asset sale, these ones are presented as investing. These ones are presented as investing what? Now cash flows. So later in the statement of cash flow, we will acknowledge that cash from asset sale, we then have that 22 what? 22 million. Let's proceed on to the next one. We go back to the question and look at note number 2. We go back to the question and look at note number 2. And what are we told in note number 2? We are told that depreciation charge for the year ended 30th June 2022, now that was 43 million. What does depreciation do to PPE? Remember that depreciation decreases PPE. When then you have such depreciation expenditure, then you proceed to reduce PPE account by it. So we come back to the PPE account. We come back to the PPE account. We come back to the PPE account, and to decrease PPE, we have said that you credit, so that on the credit we'll say that we have depreciation, and the depreciation is 43. That's 43. So that's 43. So that's 43. All right. Let's go to note number 3. Let's go to note number 3. And in note number 3, we are told that 50 million shillings of the convertible loan stock was converted to 50 million shillings ordinary share capital at par during the year. Now look at under the non-current liabilities. We actually have that loan stock thing. So we actually have that loan stock. When you look at the change in the loan stock, you know we have exactly that 50 million. Because at year start we had 150, and then at year end we now have 100. That means we have a decrease by the 50 million. And if that is the case, then when you convert the loan into shares, now 2 things happen. One is you decrease the loan. That is what we have seen as per the loan account, the decrease by that 50. And because you are converting it Into ordinary shares, it's more or less like you are issuing ordinary shares. When you issue ordinary shares, you increase your share capital. So one more account, this is now working number 4, that I want us to prepare is the ordinary share capital account. So let's prepare the ordinary share capital account, so that this is now ordinary shares account. This is equity, and equity are normally credits. That means on the credit, begin with the balance what? Brought forward. And the brought forward balance for the share capital. Go to the balance sheet again. The ordinary shares and the balance sheet for 2021, we have 150. And then on the debit side, we then have the balance carried forward. And the carried forward balance, we have 230. We are increasing this share capital by the conversion of the loan stock. You know, we have said when you convert the loan stock into ordinary shares, you decrease the loan stock like we have seen. But then because you issue shares, you increase the ordinary shares. So to increase ordinary shares, we credit it and say that the conversion is 50. What is this? This is a 10% loan. So 10% loan, I say that converted. If that is the case, then balance of this share capital account. And if we balance off the share capital account, you realize that the debit is more at 230, so that the credit will also have 230. What we are interested in, remember, is that balancing figure. And the balancing figure comes to the 230 minus this 150 minus this 50. That balancing figure is therefore now 30 million. And when we calculate such a balancing figure, the question is, what is this? You know, because we are looking at the statement of cash flows, where concern is cash flows, where concern is cash, then this must be something related to cash. And what is this? You know, the ordinary shares is a credit account. It's a credit account. Anything that then appears on the credit of it is something that increases it. Mostly the share capital increases when you issue shares. Because we are looking at cash flows, then this must be a cash what? A cash issue. That must be a cash issue. So later in the statement of cash flow, this one will be a financing what? A financing cash flow. Any cash flow in relation to raising capital. Now that's financing. So under the financing cash flows, later we'll have that 30. But then this is the thing. When you have such an issue of ordinary shares, you know, we do record the ordinary share capital account at par value. And sometimes you may not issue at par. Most of the times issues will be done at a price that is more than the par value. When you have excess over and above the par value, then there will occur now share cash for a share premium. Let us check the share premium account. Go back to the question, and under equity, let us check the share premium account. Did the share premium account change? Remember, the share premium is after the ordinary share capital, and at the start of the period we had 0. At the end of the period we now have what? 30. That means that this issue was therefore not done at the par value. It was done at what? A price above the par value, which is what is now giving us that increment in a share premium. What therefore happens is that the total cash, then from issue of shares, is therefore what figure? You know, it is this 30 for the par, the 30 for the par value, plus the increment for the share premium. And the increment for the share premium, that is also 30. So total cash from our shares issue, we therefore have that 60 million. And this is what we then report, yeah? Remember, as the financing what? Cash flow. So this is what we shall report as financing, cash flow. All right, let's go to the next. Now, we are through with the notes. For the notes, that was all, yeah? For the notes, that was all. And if that is all for the notes, we now come back to the 2 financial reports, the P&L and the balance sheet. Now, before we can look at anything else, you know, we have the account for PPE, which we have not yet balanced off. Let us balance off the PPE account. But before you can do that, check the revaluation reserve account, because normally when assets are revalued, when PPE are revalued, then you adjust that in the revaluation account. Look at under equity and check the revaluation reserve. The revaluation reserve was 67 million period start. At period end, this decreased to 30 what? 36. What does this mean? You know, decreasing PPE by revaluation means that you have what we call a revaluation what? Deficit. And the reserve decreasing means that we then decrease this PPE in value. To then decrease PPE in value, again we credit PPE account. So that on the credit of PPE account, we'll say that we have revaluation. So we'll say that we have revaluation. We'll say that we have revaluation. The revaluation decrease is what figure? You know, it decreased from 67 to 36. How much is that? So that's a decrease by, somebody says in the chat that that's a decrease by 31. So that that's a decrease by 31. So that's a decrease by 31. So you credit a PPE account, it's a decrease by 31. So if that's the case, then we can balance off the PPE account, balance of the PPE account. And if you balance it off, I would want to believe that the credit of it is more at 429, so that the debit will also have the same 420 what? 29. We are interested in what is this balancing figure. And that balancing figure now comes to this 429 minus this brought forward balance of 264. So that comes to about 165. And what is the 165? You realize that PPE is an asset which is a debit. When you debit anything in an asset account, it means that you are increasing the asset in value. And what would make the PPE then increase in value by this 165? Because again, we are still looking at cash flows, then this must be a cash what? A cash purchase. PPE often increases when you purchase more. So that must therefore be a cash what? A cash purchase. As you later prepare the statement of cash flow, this one is considered an investing. This one is considered an investing what? Now cash flow. So that's considered an investing cash flow. All right. If that is the case, then we can look at the next item. Now, let's go procedurally. I want us to look at the balance sheet and look at the balance sheet items one by one, yeah? In the balance sheet, the first item was PPE, which we have dealt with. Now, that was followed by the intangible assets. The intangible assets, look at what happened to them. At the start of the period, we had 50. At the end of the period, we have how much? 40. That's a decrease. What makes the intangible assets decrease? Normally, the intangible assets will decrease when you amortize them. So that decrease is what we consider the amortization then for the year. The amortization then for the year. And that amortization is what figure? The decrease is 50 minus 40. Now that's a 10. So that's a 10. For the amortization also, remember it's an operating cash flow. So later under the operating cash flows, we will adjust for that amortization. We will adjust for that amortization. All right. Let's look at after the intangible assets, what do we have? We have something called the financial assets through OCI. And look at what happened to that account. That account increased from 10 at year start, remember, to 22 million at year end, meaning that let us prepare an account for this asset. Let us prepare an account for the financial assets through OCI. So let's prepare an account for it so that these are the financial, we say assets through OCI. At the start of the period, so an asset is a debit, and so on the debit side, we have balance brought forward. These assets were how much period start. We are told that they had what value? 10. And then at period end, we then have balance. We then have balance what? The balance carried forward. So we then have the balance carried forward. And the carried forward balance, we have what figure? This one is 22. Now, before you can find out the actual increase in this thing, you check whether there was a change on this through the reserve that we do have for the financial asset through OCI. Go all the way to under equity. Look at the balance sheet under equity. One of the reserves is the financial assets through OCI, what is called equity reserve. So that is similar to the revaluation reserve for the PPE. So that the reserve for these financial assets is then that equity what? Equity reserve. Now look at what happened to it. At period start, it was a 0. And then at period end, we actually have a 2. So that reserve increased. And you know the reserve only increases when you increase the asset in value. So that increase in that reserve means that we increased these assets in value. And so, you know, being an asset, you debit and say that we have equity reserve. And what we bring here is the increase. And that increase we have seen is a 2. That increase we have seen is how much? 2. You know, with that you balance off this account. With that you balance off the account so that the credit is more at that 22. The debit will also have 20 what? 22. If that is the case, again, we are interested in what is the increase in this thing. So the actual increase is this 22 minus 10 minus 2. And that comes to about 10. The increase is actually 10. And what therefore is this increase? Yeah, so we've seen in the case of PPE that a debit to an asset account means you increase it, and that is therefore most probably now cash purchase. That's most probably, so cash purchase. Being purchase of an asset, this one we will classify again as investing. Again as investing, now cash flow. So again as investing cash flow. Let's look at the next one. And the next one, you will, now let's go to the current assets. Where we have inventory, we then have receivables. Now those ones we will simply be checking whether they had increased or decreased, and we can do that in the statement of what? Now cash flow. The next item under the current assets are what we call financial assets at fair value, and then what we call the cash and what? Now cash equivalents. Those two items are normally components of what? As working number 6. Those two items are normally components of what we call the cash and cash, the cash and cash equivalents. And for the statement of cash flow, for the cash and cash equivalents, we need to determine 2 things. How much is the brought forward? So how much is the brought forward? How much is the brought forward cash and cash equivalents? Then how much is the carried forward? Also cash and cash what? Equivalents. Now this is what we'll do. The first cash and cash equivalent are those financial assets at fair value. So we'll say that we have financial assets at fair value. They brought forward the balance for it. We have 30. And then they carried forward the balance for it. We are then told we have 65. Brought and carried forward the balances. Apart from the financial assets, we are told that we have cash. We are told that, or even before the cash, or even before the what? The cash. There is something related to the financial assets, and this thing is in, I want you to go to the P&L. Go to the P&L. One of the items added to the gross profit, you know, we have what we call the gain on financial assets at what? At fair value. So these assets are gained value, so that when they gain value, you must adjust for the gain. So gain on financial assets. And when an asset increases in value, when an asset gains value, you increase the balance brought forward. So you add to the balance brought forward the gain in the value, which in that P&L we are told is how much? 5. Yeah, so then apart from this, like we had proceeded, we are saying that we also have what? Cash. You know, just after the financial assets, we have the cash and cash equivalents, yeah? So that cash, they brought forward was what figure? They brought forward was a 0. And then we are told that we have carried forward of 29. 0 and then carried forward of 29. Alafu, the cash and cash equivalents should also include what? Bank. When you don't have positive bank, under the current assets, as we have seen, we have cash. Then you check under the current liabilities. Because, you know, for the bank, it's possible that you have a negative. Negative bank is what we call a bank overdraft. And when you look at under the current liabilities, we have bank, and this is the bank what? The bank overdraft. The bank overdraft. The brought forward balance for it, we are told we have 20 what? We are told we have 22. So that under the brought forward, we'll have negative 22. Remember, an overdraft is a negative. And then carried forward for the bank overdraft, we are not given anything. So that's a 0. That's a 0. If that is the case, then we can compute the total brought forward and carried forward. Now cash and cash what? Equivalents. So I'll simply add them downwards. And that gives me 13 and then 94. All right, we proceed on the next item, which I want us to look at is, let's go to under equity. And let us look at, we have looked at all the first 4. We have looked at the first 4, all of them. So the last one is the one that we are left with, and that is the retained earnings. So as working number 7, I want us to look at the retained earnings account. Let's look at the retained earnings. The retained earnings account. So that this is now the retained earnings account. Now, Being equity, that's a credit, and so on the credit side, begin with the balance brought forward. And the brought forward balance for the retained earnings, we have how much? This we are told that is 91. And then on the debit, we compare that with the balance carried forward. And the carried forward the balance, we then have what figure? We have 121. All right. We normally adjust the retained earnings by what? By the profit made. Remember, for the period. When you go back to the P&L, somewhere you have profit for the year. That was actually the last item, and we are told that is 60 what? 67. So this balance brought forward for it, you then on the credit adjust it by profit for the year. By profit for the year, and the profit for the year we have 67. So balance of the account. If you balance off the account, you realize that which side is more? Looks like the credit side is the one which is more. So 91 plus 67, that's 158. Yeah, so the debit will also have 158. Again, what we are interested in is that balancing figure, and that is 158 minus 121. That gives us about 37, yeah? And somebody, what is this 37? This is also something cash related. What is this 37? Somebody? Yeah, so in the chat, Faith says that that is the cash dividends paid, and that's correct, yeah? You know, retained earnings are a credit. Anything that you debit in it decreases it, and retained profits are normally decreased by dividends. So profits are normally decreased by, so this will say is the cash dividends of cost paid. So later on in our statement of cash flow, now this one will be a financing. This one will be a financing cash flow. So this one will be a financing cash flow. So that will be a financing cash flow. That will be a financing cash flow. So that will be a financing cash flow, yeah? All right. After equity, you know, we then have the non-current liabilities. Now that loan thing we had seen on it, and then we go to the current liabilities. There are two liabilities there which I would want we look at their accounts. One is the interest payable, and then number two, we have the income tax now payable. Let's prepare their accounts. And what I'll do is to prepare just one account. What I'll do is to prepare just one account. I'll prepare one account, but with 2 columns. Just one account, but with 2 columns. A column for each of the 2 liabilities. Yeah, so one will be the interest liability, and then the other one will be tax. So the first column for the interest and the other column for the tax. By the way, you can prepare them separately if that is how you want to do it. You can prepare each of the 2 accounts separately. So let me just title these liabilities. So liabilities for the interest and then for the tax. Liabilities are normally credits, and so their balance brought forward, you credit that. So that interest brought forward, the interest payable brought forward, we had what? 3. And then for the tax brought forward, we are told we have 30 what? 34. So 34. If that is the case, then on the debit, we'll say that we then have the balance carried forward. And interest carried forward, we have 7. Now the tax carried forward, we have 19. Now, what adjustment do we need to make on the 2 accounts? We need to adjust for the charges to the P&L. What were their charges to the P&L? So go back to the P&L. Interest is normally finance cost. Interest is what in the P&L is called the finance cost. Now the finance cost was 17. In the P&L, you do debit expenses. You know, expenses are normally debits. So in the P&L, we do debit expenses. So with that 17, we have debited P&L. Correspondingly, we credit this liability account for the interest. We say that 17, what was debited correspondingly, you just say that P&L. What about the tax charge that was in the P&L? So in the P&L, after the profits before tax, you know, you have income tax expense, and that was 40 what? 47. So also being an expenditure, we must have debited the P&L. Correspondingly, we now credit our tax account with 47. We credit our tax account with 47. You then balance off the accounts. Of course, the credit is more. Of course, the credit is more. Of course, the credit is more. Yeah, so interest credit has 20. Tax, the credit has 81. The debit will also have the same totals. So the debit will also have the same totals. Once again, our concern are the balancing what? The balancing figures. And the balancing figures will be, for interest is 20 minus 7. So that for tax, you compute similarly. That's 13 and 62. What are these? Remember, these are liability accounts. and liabilities are credits. When you therefore debit them, by now, like now, these two debits, those are items which decrease the liabilities, yeah? And liabilities decrease when you have settled them in cash, so that these figures must therefore be the cash paid. In other words, the interest that we paid in cash was 13, and also the tax that we paid in cash was 2. Later on in the statement of cash flow, you will adjust for these ones under the operating now cash flows. And with that, I think we are now set to then proceed to look at the statement of what? Now cash flows. How does the statement of cash flow then look like? Yeah? All right, so I can prepare it here so that you must start with the title, remember, yeah? You must start with the title, remember. So like in this case, this company is called Bermuda Limited. So what we are preparing is a statement of cash flows. Remember, for the year 2. For the year 2, the year is ending on 30th June. For the year to 30th June, now this is 2022. So for the year to 30th June 2022. All right, so for a statement of cash flow, you do need 2 columns for the amount, so that the first one are shillings in millions, and then another column with the shillings in millions still. So you need 2 columns for the amount. So the statement of cash flow is normally separated into 3 sections. The first section is for the operating cash flows. So the first section is for the operating cash flows. The first section is for the operating cash flows. The first section is for the operating cash flows. Now, under the operating, when you go back to the format, let me just take you back to the format of the statement of cash flow. When you go back to the format, I had said that under the operating cash flows, I begin with PBIT, where PBIT is profit before, remember, interest and what? Tax. When we come to solving this, the questions will be set for you in a manner, yeah? So the questions will be set for you in a manner that you will not directly have the profits before interest and the tax. The only profits are before something that you'll have is the profits before tax. So do start with PBT. Do start with PBT. The profits are before tax, which you read from the P&L. When you look at the P&L, the profits before tax is 114. So that's 114. So 114. Now this you proceed to adjust by what we call the non-cash. The non-cash and non-operating, the non-cash and non-operating items. You proceed to adjust by the non-cash and the non-operating items. And before you can adjust for the actual non-cash and the non-operating items, deal with interest. So deal with interest. The profits are which we should work with, which we should start with, is the profit before both interest and tax. But the only profit we have before is the profit before tax. When you start with a profit before tax, you know that is the profit after interest, because interest is normally one of the expenses which you less. And if that's the case, we need to adjust for the interest, which is the finance what? The finance cost. And when you look at the P&L, the finance cost, we have 17. So we have 17. So this profit of 114 is minus the 17, whereas we are saying that the profit to start with should ideally be before this 17. So if this profit is minus 17, then we need to add back the finance cost of 17 so that the profit now become profit before this interest and what? And tax. With that, we can now adjust for the actual non-cash and the non-operating items. Now, which non-cash and non-operating items do we have? Somebody to give me an example, which is the most obvious one? You can talk to me in the chat. Which is the most obvious non-cash item? Yeah, so somebody says in the chat, Sarah says in the chat that we have depreciation, yeah? So we then start with the depreciation. And we know that the depreciation is, how much? We have this 43. The depreciation is 43. So you add that back. And then apart from depreciation, what else? I can see in the chart, Faith says that we have amortization. Yeah, so the next one is correctly so. We then have the amortization. So we then have the amortization. We then have the amortization. And the amortization we computed in this working number 5, we computed 10. So we computed 10. Apart from these ones, what else have we? Remember, as far as this working 2 is concerned, we had the loss. We had the loss on what? Disposal. And the loss on disposal, we have 6. Remember that that also you add back. Remember that that also you add back. So that also you add back. So in case it was a disposal profit, or a disposal profit, you minus. But that's a disposal what? Loss, and so, yeah? Now that's a negative. And so that's a negative. All right, so which other non-cash and non-operating items do we have now? Go back to the P&L, yeah? Go back to the P&L and always pay attention to the items added to the gross profit. There were two items added to the gross profit. One is the gain on financial assets. Now that's always non-cash, and so you must adjust for it here. Gain on financial assets. Now that was a 5. That was a 5, yeah? But remember, it should be a minus because gain was added to this PBT. So being non-cash, we then remove it. The other item is the investment income. The other item is the investment what? The investment income. By the way, the investment income is cash. But why do I want to remove it from here? Because it is non-operating. Investment income is an investing cash flow. So you remove it from operating cash flows. Later, under the investing cash flows, we add it back. So you minus the 6. You minus the 6. You minus the 6. And I think that is it. I think that is it. So that you add them downwards. If you add them downwards, then we have 179. So then we have 179. At this point, you then introduce the working capital. You then introduce the working capital changes. You then introduce the working capital changes. For the working capital, we do have 3 things. For working capital, we do have 3 things. 1, you have inventory. Number 2, you have receivables. And then number 3, you have payables. And in brief, what you check for is whether have they increased or have they what? Have they decreased? Now, let's start with inventory. Under the current assets, did the inventory increase or decrease? At the start of the period, we had 176. At the end of the period, we have 120 what? 123. That means that we had what? We had decrease. That means we had decrease in inventory. That means we have decrease in inventory. And the inventory is decreased by how much? How much is that decrease? Somebody? The inventory is decreased by how much? So I can see in the chart, Faith says that 53, yeah? And when assets decrease, it is a plus, because like in the case of inventory, a decrease means that you sold, yeah? You sold them. So if that is the case, a decrease for an asset, now that's a plus. Let's go to the receivables. The receivables is also an asset, remember, yeah? But this one has now increased. The receivables have increased, so that we have increase. We have increase in receivables. And the receivables increased. These ones increased by how much? Somebody. These ones increased by how much? Somebody? Yeah, so by 8. So when assets increase, Remember, it's a minus in the chart. Somebody has said that by 8. So when assets increase, that's a negative. When assets increase, now that's a what? A negative. Let's go to the current liabilities and check on our payables. Check on our payables. Now, payables at the start of the period, we had 100. And then at the end of the period, we have 150, 156. So that's an increase. So we'll say that we have increase in what? In payables. We have increase in payables. And the payables increased by 50 what? That's 56. So that's 56. When liabilities increase, that's a plus. When liabilities increase, that's a plus. And so that is it. And so that is it. So you add them downwards and you add them from this 179. So you add them downwards from 179. Yeah, so that will come to a total of 280. Yeah. When you get to the point of working capital, you then introduce, at this point, you introduce two things. One is how much was the tax. So you introduce two things. So one is how much was the tax paid. And then number two, how much was the interest paid. And we had computed those two as well. Yeah, every payment is a negative, so that these ones will come here as negative. So tax paid, you come all the way to this last working. Tax paid, we computed this 62. And then for interest paid also equal to interest paid in the last working, we computed this 13. So at that point, so at this point, you minus the two. The beauty of the statement of cash flow, if this were to be set for you, is that the format of the statement of cash flow is always the same. So that at that point, just remember that you minus these two. How much is taxation paid? And then how much is the interest what? Now paid. If that is the case, then we add them downwards again. But now what we get, we call it the net operating. What we get is the net operating cash flow. So what we get is the summarized operating what? Cash flow. So we call that the net operating cash flow. And just one more thing, the total for this you now put under, the second amount column. The total for that you now put under the second amount what? Column. So you now go to the second amount column and then have the 205. So that that is it. Then for the operating what? Cash flows. So remember that you start with PBT. You should ideally start with a PBIT. So when you start with PBT, you must add back the interest so that your profit is PBIT. So start with PBT and then adjust for the non-cash and the non-operating items. Once you've done that, you adjust for the working capital changes, and then thereafter you minus these two things. You then get the net operating what? Cash flows. Now that will take us to the next category of cash flows that we call the investment. The investment, now cash flows, or investing. Call them investing, or call them investing cash flows, not investment. And you'll excuse me for a minute. Excuse me for a minute. Excuse me for a minute. All right, so which we can continue. Which investing cash flows did we calculate, did we determine in our workings? The first one is, we had this purchase of PPE, yeah? We had in this PPE account, there was the cash purchase of PPE, the 165. We said that is investing, yeah? The investing cash flows are to do with two things majorly, yeah? One is cash flows to do with purchase of non-current assets, and then number two, cash that you receive when you sell the non-current assets. So majorly, those are what you should be looking for. So number one, we are saying that we have cash purchase. The first one, we have cash purchase of PPE. And in working number one, we computed this 160 5. Now remember, I'll say equal to negative, then I copy that. This has to be a negative. Whenever you purchase something, you spend money. Money spent is a minus, And so, now that's a negative. When you look at this working number three, we have also said that we have cash received. We have cash received. We have cash received from sale of PPE. And when you sell, you receive cash, so that this is a plus. So this was 22 million. That was working number three. I can then come to this working number, these financial assets through OCI account, yeah? We didn't even number this one, but all the same, it's okay. So financial assets through OCI, we again had cash purchase, that of 10 million, yeah? So I'll say that we have cash purchase of financial assets through OCI. So cash purchase of financial assets through OCI. So that will also be a negative because we have spent money. So negative 10. And then apart from that, there was which other investing cash flow? You have to remember that from operating cash flows, we did minus this investment income because we said it is non-operating. So you remove from operating, but bring it to investing. Bring it to the investing cash flows. Bring it to the investing cash flows. So investment income, it comes to the investing cash flows as a plus. So plus 6. Plus 6. Plus 6. I want to believe that that is it. And if that is it, then we can get the net. The net investing cash flows. The net investing cash flow. So the net cash flows they go to the second amount column. So under the second amount column, we then have the sum of all that. So that's 147 minus. That's 147 negative. And then lastly, we have financing. Cash flows. So lastly, we have the financing cash flows. And The financing cash flows are which ones have we seen we do have? I think you can start with this working number 4, where we had issue of shares through ordinary and share premium. So because we issued shares, then we receive cash. So cash from issue of shares, the cash from issue of what? Shares. Now the cash from issue of shares is, we computed this total of 60. That working number 4, yeah? The ordinary shares of 30 plus the increment in a share premium of 30, we had that 60. And it's a plus because we are receiving money, yeah? So it's a plus because we are receiving money. What other financing cash flow do we have? Yeah, you come all the way to this working number 7. In the retained earnings account, we saw that there is also cash dividends what paid. So that as a financing cash flow, we have cash dividends. Cash dividends are paid. And every payment is a negative, so it comes to the statement of cash flow as minus 37. So it comes to the statement of cash flow as minus 30 what? 37. And I'm not sure whether we do have another financing cash flow. Let me just check to be sure. The workings. I cannot see another one, yeah? And if that is it, then we add them downwards so that we get the net financing cash flows, the net financing cash flow. And the net financing cash flow is equal to the sum, yeah, of these two. So that's plus 23. And then at that point, we are done with the second amount column also. And so we can compute for the year. We can compute for the year the change in cash and cash equivalents, the change in cash and cash equivalents for the year. And the change in cash and cash equivalents for the year is now the sum of the net cash flows on the second side, the sum of the three, the sum of the net operating, net investing, and net financing. The sum of the three is the change in cash and cash equivalents for the period, and that comes to about 81. That comes to about 81. At this point, you then introduce the cash and cash equivalents for the period. Rather not for the period, but brought forward. How much was it at year start? Then again, cash and cash equivalents. So if you add the brought forward to the change for the year, then you get the cash and cash equivalents carried forward. The cash and cash equivalents, remember, was this working number 6, the brought and carried forward. We have both. So remember the brought forward, we computed this 13. And then the carried forward, we computed this 94. So just confirm that if you take the change for the year 81 and you add the brought forward of 13, then you get the carried forward of 94. Somebody to confirm that for us. When you take the change for the year 81 and you add the cash and cash equivalents brought forward of 13, you get 94. Yes? Yeah, so I can see in the chat, Faith and Sarah are confirming that yes, you get 94. So that's it for how the statement of cash flow is done. Yeah, is anybody having a question? Kuna mtu wako na swali? Faith, what's your question? You may have to type because I think you guys are muted. If you have a question, please type in the chat. All right, so my intention was to look at the statement of cash flow today. And that is what we have done fully to completion. Ian has a question that the cash and cash equivalents, should it be equal to what's on the balance sheet? Not really, Ian. Not really. What is in the balance sheet as cash and cash equivalents, remember, were these figures, these ones. What is in the balance sheet as cash and cash equivalents were these figures. But apart from that specific one, there are also other cash and cash equivalents. Like when you have financial assets at fair value, there are also financial assets at fair value are cash equivalents. And then apart from that, you even have bank. Bank is also part of the cash and cash what? Cash and cash equivalents. So the balance sheet one we adjusted so that now the brought forward came to 13, the carried forward came to 94. And so that 13 and 94 are then the reconciliations here. Yeah, Faith is asking, how did we arrive at the amount for investment income, -6, and gain on financial assets, -5? Faith, are those figures we got from the P&L. Faith, you can refer to the P&L. Added to the gross profit, we had the two figures of 6 and what? 6 and 5. Faith, you can refer to the P&L. Those figures were there in the P&L. The 5 and the 6, we copied, we just picked from the P&L, we did compute them. So you just copy them from the P&L. Who has another question? Yeah, so Ian is talking about, I kindly send the recording for consolidation class on Monday. Sawa Ian, that's noted. Nani yako na swali ingine? All right, then we will be stopping there for today. let's continue next week. Yeah, let's continue next week on Sunday. On Sunday. So enjoy the rest of your weekend and see you guys next week. Asanteni sana, yeah. All right.